Well, hey there, everyone. Happy Wednesday, February 4th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a definitely not virtual background, Boston, Massachusetts. Just arrived here today. Sorry for the late kickoff on today's show. It had to get to Boston, get to the hotel, get all set up. The lighting is absolute crap in this room, which is why I'm going virtual background. I'll see if I can improve on this for tomorrow, but I was going for speed and visibility priorities. So I hope this is all right for all of you guys. Great to be with you here today. Great travel day, and excited to share with you what ended up being a pretty interesting session here. We got some earnings after the bell with Alphabet reporting. We're going to take a look at what happened, post earnings report just in the after hours session, but talk a little bit more about the performance going into today's earnings report. Growth has been getting dinged big time, and you're going to see how semiconductors are underperforming. We're going to see how some of these breakdown names continue to break down. But I'm also going to point out a bunch of stocks that are just going up. As a matter of fact, the advanced decline lines are making new all-time highs this week. I'll say it again. With all of this negative rotation out of mega cap growth, the cumulative advanced decline lines on the major indexes in the US are making new highs. That speaks to the strength and breadth. That speaks to the fact that this is still a pretty decent bull market in certain sectors. It's the value sectors. It's industrials, materials, energy, even financials getting a bid, consumer staples. It's just not tech. And so, again, keeping your focus broadly outside of the technology space. And this is something we try to nurture with our content and certainly with our market misbehavior premium members, is reminding you that it's not just about growth. And a year like 2025, when it was growth over everything, that's great until it's not. And this is one of those times where it feels like it's not. With that in mind, let's look at the market recap here. We'll talk about what happened in the major equity averages. We will look at the heat map and talk about some of the areas where we are seeing strength despite some weakness in some of the names you're familiar with. Then we'll look at some charts that I've hand selected to share with you. Let's get started here. The S&P 500 down 0.5%. The NASDAQ down 1.5%. That's a big down day. The NASDAQ 100 even worse, down 1.8%. And both of those actually were off their lows in the 12 o'clock hour. They're even worse. That's recovering a bit going into the close. The Dow finishing higher 0.5%. So the Dow up, the NASDAQ down, the S&P in the middle slightly lower. Punchline is the S&P once again not making it above 7,000 and seeming less and less likely that something that's going to happen, given the deterioration we've seen in the largest names that are the biggest weights in our U.S. benchmarks. Check out mid caps and small caps, both finishing with some pretty decent up days, both in the green, both outperforming the S&P. So small over large continues to be a theme here in 2026. The VIX, similar to yesterday, spent some time midday above that 20 level. That's that red level, that red line that we talk about. Anything above 20 is kind of an uh-oh level, because that means the volatility is high. That means that the options market is pricing in larger price swings. In the afternoon, the VIX did come down a bit. It finished just below 19, so still technically a low volatility environment with the VIX finishing below 20. But let's keep an eye on that one, certainly. It seems very, very close to closing above that 20 level. Major pullbacks in October and November certainly saw the VIX push above 20. Looking at interest rates, kind of a quiet day, to be honest with you, with fixed income markets. 10-year yield really unchanged, still around 4.28. Long bond yield slightly higher, around 4.92. The TLT was down about 0.25%. The dollar moving higher, and what's interesting is the dollar moved higher, about 0.33%. Go to the next page, you can see the most commodities were actually up as well. Gold was flat for the day. Copper prices were lower, but silver up, crude oil up, natural gas up. So these are some areas that felt some major league pain over the last week. Nice recovery all around. The energy sector ended up having a pretty good day as well, with crude oil prices continuing to recover here. Not seeing any really pause in the major downtrend we're observing in Bitcoin and Ethereum. Bitcoin down about 4% today. Ether prices down about 4.5%. You can see all 10 of the top coins tracked on the stock charts platform finished in the red today. So we're continuing to see a big time risk off move in cryptocurrencies. Now, cryptocurrencies topped out earlier, a couple months ago, and have been rotating lower and had that bit of a bounce in January, and then just accelerating to the downside over the last week or so, just continuing to push lower, currently trading just below 73,000, but that's down quite a bit from 95,000, which is where we were not too long ago. So continued weakness in cryptocurrencies, we see those as risk-off charts, primary trend lower until further notice. Looking at the 11 S&P sectors, you can see 7 out of the 11 were up. The problem for the major benchmarks is 3 out of the 4 that were in the red are the FANG sectors. We'll start at the bottom with technology down 2.8%. That hurts. And that is the continuation of this breakdown scenario we've been talking about with mega cap growth struggling. The technology space is pulling back. The AI trade is unwinding. It's not end of the world kind of looking yet, but it's getting less, certainly less ideal. It certainly implies that there's a revaluation happening with large cap growth. You can see communication services and consumer discretionary both down as well. Not as bad as the XLK, but certainly not great. On the top of the list, you have materials up 2.4%. You have energy up 2.3%. You have real estate up 1.6%. So two of those pretty, sort of value-oriented kind of cyclical sectors, materials and energy. Real estate and consumer staples are more defensive sectors, also having pretty good days as well. So generally, this is a move away from growth into value, something we've been documenting for quite some time, very much more of the same here. Now, what's so interesting is on this day when tech was down big, on this day when the NASDAQ was down big, the S&P was certainly not up, the breadth was pretty great. It depends on where you look, right? You can see this second line down with the red. That's the breadth on the NASDAQ composite. Now, to be clear, the breadth on the NASDAQ composite is never great because there's a lot of kind of junky names in the smaller end of the NASDAQ, but 38% of that index was up. That's not a lot. 58% of the New York Composite Index was higher. 73% of the S&P 500 members were up. So that's about a 3-to-1 ratio of stocks up versus down. That is a strong breadth day. So even though the S&P was down, the breadth was quite strong. This again tells you it's in some ways one of those easy opportunities to outperform the benchmark because you just need to be underweight tech and you just need to be looking for things that are not going down. And there are plenty of things that are going up big time, as we can see by the fact that the breadth continues to improve. All right, continuing to the Magnificent Seven, friends, let's be clear. Not all of the Magnificent Seven were down today. Apple, actually, I would argue, along with Alphabet now, the two strongest charts of this basket, up 2.6%. Microsoft up 0.7%. Netflix up about 1/3%. Microsoft and Netflix have not been particularly great charts here. Those are bouncing off of some pretty low levels. But the pain is at the bottom of the list. Broadcom, Tesla, NVIDIA, Meta, all down over 3% today. Amazon down 2.4%. Alphabet down 2% going into today's earnings release after the close. That's the biggest earnings name to think about here. All right, let's go to the heat map. As a reminder, we appreciate your questions so much. Please use the comment section on our YouTube channel for any questions that come to your mind as we're going through these concepts, as we're going through the heat map, as we're going through the individual charts. Nothing's out of bounds. We are planning an all mailbag episode at the end of this week, and we'd love to answer one of your questions on the show. Easy to drop a question in the comment section of our YouTube channel. Hey, feel free to like the video while you're there. I'm sure that doesn't hurt. Tell a couple hundred of your friends to check us out tomorrow. That would help as well. All right, looking at the heat map, as we've seen with many days, a lot of red in the technology sector, but not everything, right? Let's keep in mind when you look in the upper left corner, this is technology, which is about 1/3 of the S&P 500. A lot of stocks going down, particularly in the semiconductor space. This is where we're seeing a big time revaluation to the downside. AMD down 17% today. Lam Research and Micron both down 9-10%. Applied Materials. And these are all names that have been strong charts until they weren't. And that is the issue we talked about during these long uptrends. It's like, look, this is why we keep reviewing the evidence, because at some point, those great charts aren't going to look great anymore. And I would argue those names that I just mentioned are in varying degrees of not so great to very much not great. Having said that, there are a number of stocks in the technology sector that actually bounced higher today. Now, a lot of these are names that have not been doing particularly well. Charts like Adobe or CDW or like Hewlett Packard, right? SMCI. Super Microcomputer is up 14%, but it's still down a ton in the last quarter. So, not a lot of these are particularly strong charts, but it shows you that there are some things actually popping higher today. Maybe the outlier would be ADI, right? Analog devices making a new all-time high today. That's one of them that just remains in a strong uptrend. But the rest of these are a lot of kind of beaten down names like CRM having a bounce, but they're still pretty ugly charts. So technology continues to be not where it is. But look at all the green that you see in the right half of this visualization, right? In the financial sector, plenty of things working today. In industrials and consumer staples in the upper right, energy, materials, real estate in the lower right, even some healthcare. Eli Lilly threatening a new all-time high, teasing 1100 going into the close. Amazon and Tesla were both down, which is weighing on the XLY, but you can see a bunch of other names in the consumer discretionary space actually having some decent upswings. Look at Starbucks, right? Bouncing, breaking above the 200-day, pulling back to an ascending 21-day EMA, and now starting to rotate higher. So again, I'm seeing some interesting bounces around the sectors. And I think what you're going to find with technology and with consumer discretionary and with communication services, it's the FANG stocks in those sectors that are struggling. It's the big names, and then semiconductors as well. You group those together. But outside of those largest names, there's a lot of green in each of those three sectors. It's just not in the names that we're kind of accustomed to thinking of as leadership opportunities. So great reminder to use something like this heat map. This is called the market carpet on stock charts. And a lot of other platforms have pretty good, heat map style visualizations. I think something like this where you just don't miss the stuff that's good, particularly on a day when the benchmarks are down. I can't stress enough that is a really good use of your time. I would humbly propose. All right, we're going to move on quickly here to look at some charts for a bit of an abbreviated show tonight, but I do want to let you know I am participating in what promises to be a ton of fun. My good friend and fellow Stock Charts contributor Tom Bowley invited me, along with Grayson Rose and Julius DeKempner of Stock Charts, to join him for what he is calling the Super Bowley, a fantasy stock draft. I think we're going through 10 rounds. We are each basically, drafting a team of stocks. We have some restrictions in terms of what sectors need to be represented, in terms of how we're going to pick them in the order. But it should be a ton of fun, some minor trash talking, along with a lot of great insights using the charts. Tom's awesome. He's a fantastic technical analyst. I'm thrilled to be included. You can sign up for this event coming up this Saturday by scanning the QR code that you see on your screen, or just go to marketmisbehavior.com/Super Bowl, and you will get to this page. It is not the actual Super Bowl where I will, sorry, Patriots fans, I will be cheering wholeheartedly for the hometown at Seattle Sounders. Thanks again, Tom, for inviting me. I hope you guys can join me at that event. All right, I did want to share with you, by the way, I met the folks at ProShares down in Tampa a couple of weeks ago, a couple of guys there, and had a really good discussion. They actually have a sentiment indicator that I want to share with you, and I want to just thank them for allowing me to show this on the show. I'm working with them to get some, better sort of data source that I can have to start to put this in a chart format. But they actually have a daily bull bear indicator that's based on the ProShares funds. I've got a lot of great data on the AUM, the assets under management, on the different ProShares. So they're looking at the leveraged S&P ETFs. How many, what assets are in the leveraged long ETFs versus the inverse ETFs or the leveraged short ETFs. And so, if the AUM was even between the two, this indicator would be about 50. It's currently around 87, which is right around the highest level that it's been in the last year, and actually around the highest it's been in the last 5 years. So to summarize what this visualization is telling you, the folks at ProShares are tracking AUM of all of their different, leveraged and inverse ETFs, and basically are seeing that the ProShares clients are in the most bullish positioning that they've essentially been in 5 years. So the ProShares, trading community, people using these, and this is updated every day. This is as of today's reading, pretty high. I think this is kind of an interesting one. This is a new indicator. I haven't back tested this indicator. I don't have deep history like I do for the AAII survey, but I love when a company like ProShares is willing to share some insights based on the flows that they're seeing between their funds, and that data it can be very rich in terms of investor psychology. So let's keep an eye on this. For now, I'm just noting that this basically says it's a very crowded bullish trade right about now. I'll be very keen to see if that number starts to go down, if we would get into some sort of corrective environment. I haven't studied what has happened in previous pullback scenarios, but something to keep in mind. All right, let's look at some charts, shall we? The S&P 500 kind of going the wrong way, getting further and further away from that 7,000 threshold where I threatened to drop some trumpet playing on the show here. So still not doing so. The S&P did trade below its 50-day moving average as it did yesterday. It also closed back above the 50-day, same as yesterday. So a close below the 50-day would be a sign of concern, right? That would tell you that we're starting to lose our ground and actually starting to follow through to the downside. Last time we closed below the 50-day, we bounced right back above it the next day. So we're looking for something different than we've seen on these pullbacks in January and December, right? So a close below and then follow through would be a really negative sign. For now, I see this as a neutral chart with the S&P in the yellow light quadrant, with the S&P essentially at the same exact level it was at the end of October. By the way, I've got a video with my editor, hopefully out to you very, very soon. Today, might be tomorrow morning, the Choose Your Own Adventure style video looking at the S&P 500, laying out 4 different scenarios. Keep your eye peeled on my YouTube channel. Make sure you subscribe to the channel if you haven't done so already, and you won't miss that video. It's a great exercise, forces you to kind of think outside the box, look at, think about different scenarios that are different than your actual thesis, but then you get to vote on which you see as most likely, but you also get the benefit of seeing what other people think. So if you're all bulled up, you get to read some comments from bears and hear what is causing them to be so bearish. How are they looking at the same stuff you are and they're not as optimistic? That's one of the great benefits of challenging your thesis. And hopefully I can provide a great opportunity to do that. All right, this is a chart I just wanted to share with you with some key kind of ratios here, or indicators that I think tell a great story about what's happened so far in 2026. So the S&P is on the top, and again, I mean, there are periods when the S&P is clearly in an uptrend. This is more of a sideways trend in 2026 so far. It is technically still up for the year, but not by much. It's really more of a sideways kind of consolidation phase on the S&P. However, while the S&P is dipping lower here in the first week in February, the cumulative advanced decline line for the New York Stock Exchange made a new all-time high today. So as I mentioned in the introduction, the breadth is strong, despite the index is showing a little bit of weakness or just lack of strength. Small versus large has actually been very noisy. The first couple weeks of the year, small caps were really outperforming. Over the last week and a half, large caps have been outperforming again. Small caps underperformed, starting to turn higher a little bit today. So it actually has been a choppy relationship between small and large. That's still a very fluid situation. I'll tell you where there's been an absolutely clear signal and no confusion has been offense versus defense. The defensive sector of consumer staples has been outperforming the offensive sector of consumer discretionary. That speaks to the fact that investors are rotating toward defensive positioning within the consumer sector. This is an indicator I've used for many, many years as a way of measuring investor sentiment by looking at flows around the consumer sectors. This is a risk-off vibe that we have been observing since the first week in January. Persists for now. By the way, the cumulative advanced decline line on the NYSE, that was the one I showed in that previous chart, but the S&P large cap, the S&P 400 mid cap, and the S&P 600 small cap, all 4 of those made new 3-month highs today. Some of these are just kind of barely getting above their July 2025 highs. I think they technically both did today, but not by much. My point is all of these are trending higher. The breadth is good. However, there are 2 kind of traditional warning signs that I see flaring as well, and that's on top of the offense versus defense. That's a big red flag right now. Red flag number 2 would be the VIX pushing above 20. The last couple sessions, we've gone above 20, but by the close has been back below. Let's keep an eye on this, because if this closes above the 20 level, that would be a very negative sign for the S&P right now. It's teasing that threshold. The other thing I want to point out just in the last 2 weeks is that high yield spreads have just started to widen out. When credit spreads widen out, that implies that bond investors are starting to see potential risks on the horizon. They're starting to demand a little more compensation for opening or for owning the bonds of risky companies, what we call high yield bonds or junk bonds. As a result, spreads start to widen. These are trading at a higher level versus, or a higher spread versus a treasury bonds. That widening in credit spreads, along with the increase in the VIX of volatility, usually coincides with stocks rotating lower. So the fact that we've seen spreads widen and we're seeing volatility start to increase, we're not really seeing that drop in the S&P yet, but that's something that most likely would come very, very soon, particularly if spreads keep widening and volatility keeps increasing. Here's how bad it's been with offense versus defense. Again, I keep this chart often, I've kept this chart for years, and I review it often. What I'm seeing right now looks a lot like January, February of 2025. Look how significantly this is rotated lower after making a new high. Both of these accelerating to the downside, indicating a risk-off positioning in the consumer space, with consumer staples outperforming consumer discretionary. Looking at semiconductors, you can see the SMH pulling back to an ascending 50-day moving average. The RSI still holding above 40s. This is not a bad chart yet, but it's getting really, really close to where it starts to look like kind of a bad chart. We're going to have to keep an eye on this one for now. That 50-day moving average is kind of a good initial level to watch. As long as we hold the 50-day, like we did like back here in early September or in mid-August, or in mid-December, not bad. We break below the 50-day like we did in November, then we have to start thinking about the potential for a much more significant decline. But until we break the 50-day, it's like that's just not really on the table. It's very close to being on the table with today, the SMH, the semiconductor ETF, trading right down to the 50-day. That's something we need to watch here this week to see if that fails to hold. Now, while the SMH is testing its own 50-day moving average, Broadcom broke below its 50-day in December and has remained below it. A couple opportunities to regain it here in early January. Those failed. We bounced off of key support going back to the September, October, November, December lows. We confirmed that once again in January, and this week we were accelerating down there. Today, we traded below the 200-day. We closed just slightly above it. But this is the first time trading below the 200-day moving average since April. If we get a valid close and a confirmed breakdown of the 200-day moving average, that says big time risk off for Broadcom. NVIDIA almost in an identical boat. A little bit of a different setup here. We're testing support right around 170, we'll call it, the 200-day moving average, almost exactly at this level. This is a confluence of support. We got a Fibonacci level a little bit below, around 164. We break those levels. NVIDIA all of a sudden does not look like a strong chart. It looks like a complex head and shoulders pattern that has broken. It's not quite there, but we're monitoring the 165 to 170 level, which is in play this week. AMD gapping lower, closed about 17.3% down, testing the November, December, and January lows. I just put out a video on this on the Stock Charts TV YouTube channel on Monday. I also just posted an article to stockcharts.com. That's in the free part of the site. So if you go to stockcharts.com, go to the article section, look for my name. You'll see an article on AMD, looking at some different phases using this chart, talking about why $200 a share is a pretty important level to watch. So as you can see, with all these semiconductor names I've just highlighted, we are right at key levels of support. This is a crucial point we'll continue to monitor. I hope you'll stay with us as we do so. Now, what makes me nervous that these are not going to hold? Because stocks like Palantir have had a similar setup and have failed to hold them. Palantir had pretty well established support around 150, had the 200-day moving average there as well. That level has now been broken, and today we rotated down another 12%. Palantir is now in a primary downtrend, I would argue, according to the charts and the momentum characteristics. Before we get all depressed about ugly charts in technology, they're not all bad. Apple making a new swing high today and breaking above the 50-day moving average. We now have the December 2025 previous highs around 289 in play. We're right about there. The RSI pushing above 60 this week. That's pretty encouraging because that tells us we're back to positive momentum, positive strength going to the upside, buying power. All right, so the class of the Magnificent Seven, the best chart by far has been Alphabet. Alphabet has been in a primary uptrend, and it's remained in a strong uptrend phase while most of the other Magnificent Seven stocks have struggled, either gone sideways or gone down quite a bit, with stocks like Microsoft and others. Alphabet still holding the 21-day EMA. We'll see what's happening in the aftermarket. Down slightly. It's not by much. It's currently trading around 329. That's pretty much exactly where we were. It's right at the 21-day EMA. So this is not that bad of a move, kind of a nothing burger at the moment. We'll see what happens tomorrow, and if maybe there's further movement as the day goes on. But for now, hanging in there, remaining the strongest chart. And then chart like Alphabet, innocent until proven guilty. Good chart. All right, one other thing I wanted to share with you. I love highlighting candle patterns. Candle patterns for me are just a fantastic part of the technical toolkit. They're very visually rich, right? They tell a story, and that's what, talking with Japanese traders who have used these and Japanese technical analysts, they talk about the names and the visual, cue, right? The fact that they visually tell a story about what's happening with the stock, and I love that idea. excuse me. Caterpillar's one. If you actually go back here, you can see a number of times where we had kind of these bearish engulfing patterns, right? Big up day, big down day, signaling a period of short-term weakness, particularly when they come in an uptrend phase. And we actually had one of those today. Tuesday session, an up close. Wednesday session, a higher open, a lower close. That's called the bearish engulfing pattern. Tells you the next 1 to 3 bars are most likely going to be lower, right? No guarantee. And we want to keep an eye on the highs of today's range as a potential stop for like a short position or a negative, a bearish thesis here. But bearish engulfing patterns popping up on names that have just made new highs always tells me, hey, maybe lighten up a little bit, maybe be a little bit cautious. Folks, that'll do it. Thanks for hanging with me today as I published a little bit later. Had to get to the hotel and get everything squared away. Hope you enjoy the very beautiful Boston background. We're going to be hanging out here in Boston the next couple of days. I'll be flying back, sadly for me, right during the Super Bowl Sunday evening, but hopefully I can stream it on the plane on the way back to Seattle. I'm literally flying between Boston and Seattle during the Super Bowl. But in the meantime, I will say thank you so much for joining me on the show. Please drop a question in the comment section on our YouTube channel. Have a wonderful evening. And remember, it's always a good time to own good charts. Take care, folks.